Good afternoon, everybody. I'm Erich Patten. I'm the Chief Investment Officer of Cutler Investment Group, and I'm joined today by Bryan Knutson, Senior Wealth Advisor here at Cutler. And we're going to be talking about our first quarter market recap. Thank you for joining us. A lot has happened. There's definitely a lot for us to talk about today. Let me share my screen here. So we've titled today's presentation, Expect the Unexpected, because this first quarter definitely had a lot of surprises for investors. And we're going to be walking through those today to try to make sense of them for you and how Cutler thinks you should be positioned for the current economy and the current market outlook. But first, we're going to start with some disclosures here. And most importantly, this presentation represents our views as of today, April 25th. But should new information become available, we do adjust our views accordingly. So, if you were to make an investment decision, always consult with your advisor. Talk with us at Cutler. We're happy to try to boil this presentation down to your specific circumstances and really find advice that makes sense for you. So today's agenda. Today we're going to be try to answer the question, have we seen the market adjustment already, or is there more to come? And we're going to start by doing a first quarter review, as well as talking through Cutler's recommended portfolio positioning, how we think clients should be allocated. Then we're going to talk about current market events with three big themes: the war in Ukraine, inflation, and then the coronavirus. We'll then move on to an economic update, which will proceed into an equity and bond market outlook. So let's jump right into it. What happened in the first quarter, and how do we think you should be positioned? Bonds were a big story, a historic story in the first quarter. Bonds had the worst quarter in their history. With rates beginning to rise, new bonds can provide even higher yields. So we're seeing some definite opportunities in new bonds. We recommend a fairly short duration portfolio. We'll get into why and how that might reduce the risk for you as an investor. But we're also actively looking to extend duration, which means we're looking to buy a little bit longer bond maturities, given the rise that we've seen in the yield curve. We think there's some opportunities in the bond space right now. What about stocks? Value stocks widely outpaced growth stocks, completely upending a trend that we had seen in recent years. We think this can continue as investors are less willing to reach for overvalued stocks. A lot of those overvalued stocks have been in the growth sector, but some of those have sold off there. We do think there's opportunistically some opportunities for investors to identify growth stocks that may be great companies that previously hadn't been a great stock, but that might have some value here today. What about foreign stocks? Foreign stocks were widely harmed by the Russian war in Ukraine. And foreign stocks do serve an important role for investors in terms of a diversifier. With everything that has happened internationally, especially geopolitically, foreign stocks have held up reasonably well. And they started the year, prior to the invasion, doing very well. So we do think it's an important piece to have in a diversified portfolio. Perhaps not a large overweight, but at least an equal weight to what you would normally have in your investment portfolio. And then finally, alternatives. And alternatives can mean a lot of different things to a lot of different people. They can mean gold stocks. They can mean real estate. At Cutler, we like to think of alternatives as a hedge fund proxy, something that really can hedge out some of the risk. We're looking for uncorrelated assets to stocks and bonds, something that might behave a little bit differently. And in the first quarter, this asset class actually created a lot of value. We think that with both stocks and bonds down, something that can perhaps hedge out some of that risk held value very nicely. Bryan, why don't you recap us on our quilt chart here? Anything that jumps out to you and really where you see, the biggest impacts from the first quarter?
Sure. So, hi, everybody. So in the first quarter, the clear leader, for returns was value stocks. they were slightly down. And those of you can read this, down less than 1% as a class. And relative to everything else out there, when you'd have a lot of discussions where people would sort of think that everything was down, not really. So what the biggest jump, the biggest impacts that I see here relative to what I would expect is the black box. That's the broad world of US stocks, big US stocks. Still finished up near the top, but it was the leadership change. It was that handing off of the baton to the, excuse me, the less expensive value stocks that made a big difference. Next down on that list, short-term bonds, negative. If you go all the way down, you can see the darker brown box, broad bonds, negative. We're going to talk about that later in more specifics, but basically, if I look there, what is one of the bigger drivers for why that class was down? Drag over a couple of years and try to explain again, like we did before, why bonds returned so much in 2019 and 20. A lot of it is interest rates, expectations for interest rates. And then the last thing that might be surprising to people, because we've become so accustomed to growth stocks outpacing almost everything, is that we have finally seen some realization that they are very expensive, and especially expensive as rates rise, borrowing costs rise, the kind of risk-free rate changes. Expectations have adjusted, expect the unexpected, as the title said, and we need to sort of rejigger our views there.
Yeah, to think about that trend a little bit differently with value versus growth. If you look at the 2020 numbers, you can see growth stocks had a phenomenal 38% just 2 years ago, far outpacing value stocks at 2.8%. Well, of the many things that happened in 2020, most notably, interest rates went to zero. And so as interest rates drop, growth stocks have historically outperformed. And this year, with the rise in interest rates, value stocks have taken market leadership. We think that they have room to run in terms of interest rates continuing to climb and value outperforming versus growth in that environment. So let's talk about a theme from the first quarter. And the war in Ukraine was more than a theme. It's a humanitarian disaster. But Bryan and I will be talking about it strictly from an economic standpoint and the market impact. Bryan, what are the impacts from the war in Ukraine on the markets?
So the biggest impact here would be, first of all, on the Russian market itself. Russia has been a member of what's been known as the BRICS, the BRIC, Brazil, Russia, India, China. Russia on its own, not a very large stock market in general. It's not a market that people tend to have a significant amount of investment in unless it's on a more speculative basis. But what happened after their ill-fated decision, I would say, to invade Ukraine? The day of that invasion is determined for this purpose to be February 24th. So what happened on February 24th? The single biggest drop for one market in history, in at least in modern history. We can see it there in that red line. Almost every other instance on this chart is from Black Friday in 1987. Keep in mind that was when there was a much smaller pool of overall investors. Values for the S&P and other indices at that time were much smaller than they are now. But almost every other one of those is going to be from 1987. Russia, on the negative side, surpassed that. Beyond that day, it got worse and worse and worse to the point where that market was frozen. You could not trade rubles. You can't short their stocks, things like that. The measure of impact here on them domestically can be seen in the tweet down below. In over 100 years, since Tsar Nicholas II, no single leader there has done so much damage internally and externally, unfortunately, so fast. Russia is now isolated from various economic and governmental and maybe some defense groups. Going forward, the ruble is essentially worthless. They have forced some countries to try to buy oil, for example, in rubles, and they have destroyed. If you think about 25 years of gains, it was about 30 years ago that the walls came down, that Russia started to open up, Eastern Bloc started to open up. What Russia has done here, both to themselves and to some of their trading partners, because keep in mind that Western Europe and most of Eastern Europe use Russia as, in many cases, their only natural gas provider. This has caused ripple effects of damage that will take years to really try to rectify.
And I think it's worth noting that for U.S. Retail investors, largely represented on this call, Today, Russian exposure is 0% of their portfolio, with the stock market in Russia being worthless, the bonds being removed from major indices across the globe. U.S. investors across the board no longer have any Russian exposure. So this doesn't represent a direct impact to client portfolios going on, but it is a very big impact, obviously, to global markets. Let's talk a little bit more about the global markets impact. Bryan, with Ukraine at war, what are we seeing in terms of a global impact?
So the major impact that we're seeing here to us here domestically and to many other countries, excuse me, around the world is not going to be the stock market there. Erich noted very well that Russia, it was already a relatively small piece of most portfolios, and now it has turned itself into a zero. Where are we seeing the impact? It's going to be on commodities. There's going to be some impact on oil with those countries like ourselves that have had some actions against Russian oil, and they are a major provider there, and natural gas, as I noted before. But here, let's look at what about the impact of Ukraine? They are a significant agricultural provider of some very important pieces. It might be a little hard to read on your screens, but that top chart shows where they rank worldwide in sunflower seeds, corn, barley, rapeseed, which you might not think of as much, but what about wheat? What about soybeans? All of those, in particular, corn that's used in a lot of fuel products and soybeans are going to be massively impactful for food supply and beyond that to things like fertilizer and such. So what does this do to the price? If you know that there's a scarcity or a concern of scarcity of a given item, my supply demand Eckie 101 tells me you're going to have some increase in price. That chart down below shows the increase in commodity price of major impactful events in history. World Wars I and II, Korea, etc. The right-hand side, those two red marks down the line, those two lines, show me that this chart doesn't just go on this scale, it goes beyond that scale. If you notice, the chart goes to 60%, but the increase this year is 144% as of the date of this particular slide. It is massively impactful there, beyond the humanitarian, which is terrible, and beyond the stock impact of Russia itself, which is minimal for us. This is the impactful part that we need to watch out for on inflation, which we're definitely going to talk about more.
And we've been talking about inflation for over a year now. And effectively, the war in Ukraine has made a global problem worse. You look at this chart on the left, you can see inflation since 1970. And we're back to 1970s level inflation. It's been a straight up spike to 8.5%. Last year, the big talk was transitory. How much of this is transitory? How much of it is permanent or sticky? The chart on the right attempts to break that down. So energy prices can be transitory. Energy, was $124 or so when Russia invaded Ukraine. Oil prices spiked. Today, they're down near 100. So we've seen some volatility there in energy prices. What about new and used vehicles? There's been a lot of price increase in the used vehicle market there due to really supply constraints from semiconductors. Hopefully those issues get worked out and that becomes more transitory. Food also notoriously very volatile, but then you have these sticky components on the bottom, like restaurants and shelter, that tend not to go down. They tend to go up and stay there. There is an opportunity for inflation to come down as this year progresses, largely on the top end of this chart on the right side that you can see here. Bryan, why don't you talk a little bit about the CPI and where it's forecast to go from here?
Sure. So there are some various components of the CPI, in particular, the one that would be called headline. That's the one that does include food and energy, which for many of us, of course, would be relevant because we buy food and we use gas and natural gas. This chart shows the increase that we have had up to that 8.5 mark. That is the most recent number we have. And then not only just an expectation that it should and can go down. Well, sure, yeah, it can go down, but where is that going to come from? That previous chart that Erich noted was very good about showing which components may or may not go down and which of them are more likely not to. And this one is showing us at an aggregate level what the impact could be of seeing some relief, in particular from the purple striped area, that's energy, and then from the orange area, kind of the core goods. So think of core goods being things like used cars or new cars, right? So this doesn't necessarily mean the prices are going to go down at these levels. It means the increases should start to mitigate, right? What we're really looking at with inflation is year over year changes. We don't expect that the price of gas is going to get cut in half, right? That just means that the trend line is going to start to taper, we believe. And even I, as a bit of an inflation hawk for the last year or so, can definitely see a case for that. If you look at the very right-hand side on the lower part of that chart, you see the purple starting to go into some negative. That would be a reduction. Eric noted before very well that the price of a barrel of oil is today closer to 100 than it is 120. If that's sort of a trend, like it's not going to go to 40 again necessarily, I wouldn't expect that, but 100 going to 90, going to 85, all of those things would be beneficial to especially the headline CPI number. And that's why I expect that we will see some relief. Will it be as dramatic as this? I certainly hope so, but at least getting down where we don't see 7s or 8s, but perhaps have that first number be in the 5s, and then go forward from there.
Yeah, and the biggest impact on inflation is the federal funds rate, which is the rate that the Fed sets for interest rates, kind of the baseline interest rate for our economy. And the Fed recently began increasing rates. We're going to talk a lot about rate changes later, especially in the bond section of this presentation. But one thing it does have a big impact on right away are mortgage rates. And you can see on the top chart here, mortgage rates have really spiked over the last couple of months. Now, historically, they're still very low. We're only at 5% for a 30-year fixed rate mortgage. But if you look at the cost of debt really to homeowners over the last couple of years, it's been very, very low, which has led to a spike in housing prices. We've also seen very little inventory. This bottom chart shows the typical number of days to sell a home. As a current number, the vacancy rate of U.S. homes is at 0.9%. That's the lowest since 1978. So we're seeing a strong move up in mortgage rates, but we also have very little inventory, especially relative to demand in the housing market. That's why we think housing prices may not crash like you've seen in 2007 and 2008, but they may moderate. And we might see a slowdown. I would expect a slowdown in housing price appreciation due to the increased costs of financing from higher mortgage rates. All right, so let's move on to our third big theme of the first quarter, which is the coronavirus. The great news here is that this has been the first theme for about 2 years. It's the first thing we would talk about on one of these economic updates. And today it's third. Bryan, why has it moved down the list a little bit?
Yes, with a sigh of relief that I can say that we are talking about this toward the end of our themes instead of the beginning. It's fantastic. So on the left-hand side here, what we can see is that with the Omicron variant, what was expected to play out and what did play out is a far wider range of cases, but much milder cases with much milder outcomes. Not universally, unfortunately, but certainly by and large. The case that I had lasted about 2 days, great. And what we see there is that big spike in the end of last year into the beginning of this year, a huge reduction back down, a little bit of increase recently, but still, I mean, nowhere near what we were looking at then. And along with that, in that gray line down below, the fatality rate much more contained, right? So as a ratio, much lower. Fantastic, right? No states have a mask mandate at this point. Airplanes don't right now. We'll see what happens, et cetera. For us and many countries, not every, that's a little foreshadowing, but many countries around the world, all restrictions effectively are gone. Great. So what has happened out of that? Let's look at the right-hand side. We've seen this chart before, and we know that the top line is independent, perhaps is the best way to put it, of the other three, but let's talk about them all. Consumer debit and credit transactions. Relative to where we got down to in 2020/21, let's see how far we went down and how far we rallied back up. Excuse me. So this is all comparable to 2019, right? Any comparison to 2020 and 21, especially for those last three, would be too easy, right? Because comparing something to very little we're going to look really good. Let's compare to 2019. At the worst point, there were no seated diners, there was almost no air travel, and there was a big drop in hotel occupancy, right? I can see that minus 100 for seated dinners means there was no one. Okay, where are we at now? About 97 out of every 100 people that were dining out in 2019 are back. I've seen some evidence so far that's even gone up since then to be over 100, but for now, let's just say we're right back almost to where we were for this chart. Hotels, very same thing. TSA travelers, which is the hardest of these to be able to get back because that is also combined with the number of flights. What's not on here is that the actual number of flights is down. Hopefully that'll be temporary as well. But even there, almost 90 out of every 100 passengers is back. I can see all of those trend lines. The bottom three in particular have had some fits and starts. We've talked about those in the past with some various situations that have arisen, but they have all trended back up. For those of us here in the US in a very much consumer-driven economy, this is all excellent news that we really hope continues.
Yeah, and this really speaks to consumer activity, and we're going to talk about consumers in a couple of slides. But before we move on from the coronavirus, there is a little bit of bad news to report, especially coming out of China. Chinese stocks have not done well for a couple of reasons. One is the zero COVID policy of the Chinese government. And a big issue with that policy is that China is the supply chain for much of the world. And right now in Shanghai, 90% of truckers aren't driving. You've got 470 ships in the harbor waiting to unload or onload goods likely headed to America. And those ships can't dock right now at ports, and so they can't be loaded. That's a supply chain problem that we experienced here over the last year or two, but it might foreshadow a little bit of problems down the road to keep an eye on. That did create a lot of inflation. You look at that used car inflation, that problem may not be going away due to what's happening in China. The bottom chart here shows Chinese technology stocks, and this is separate from COVID. This is just a government policy. Last year, the Chinese government decided to reorganize their economy away from technology toward industrial companies because they felt that those goods would better produce stable employment, stable jobs, and a better economy for them. That policy effectively was announced that they were going to move a different direction, right where this red circle is. So the red circle, the government came out and said, actually, we're no longer going to punish technology companies. And you can see those tech stocks just bounced incredibly overnight. That's a positive for Chinese stocks. So this slide's a little bit of a good news, bad news story. Emerging market stocks are about 40% Chinese. So there's a big component of Chinese stocks in those indexes. It's important to keep an eye on them. They do impact a broad range of things. But the biggest issue going forward is going to be how well does the government tackle COVID in China moving forward. So let's talk about our economy and the US economy for a minute here. We're going to start with the consumer, and this is a cartoon showing Atlas holding up the world. And the comparison in this case is Atlas is the consumer, and the consumer is really the American consumer is holding up the world economy. We think that U.S. consumer spending is a very important component. It's about 70% of our GDP comes from consumer spending. So, Bryan, can consumer spending remain high?
I would say it can, and I really, really hope that it does. And there are several reasons why. So lots of information here, and let's go over the highlights of each one of these. The left-hand side shows that the American consumer is in a really good place. Not everybody, unfortunately, but as an aggregate group, we look great. What is the first thing that I look at? Almost like I'm looking at a private client portfolio here, a 9-to-1 assets to liabilities ratio. That is fantastic, right? And then the next thing I want to know is how solid is that 9 part, the assets part? 1/4 of American household assets are in the value of their homes. That is certainly higher than it's been in the past because of the appreciation of home prices, but it's not outlandish. 25%, 1/4, that's fine. Go down below and I see a variety of other assets, cash deposits, pension funds, other financial assets, stocks and bonds. Great, nice diversified pool there. Let's look at where we were relative to the low point in 2009 when it was, that's that little arrow there, about 74 trillion at that point. We are more than double, excuse me, more than double that point, that level, without being over leveraged. How do I know that? Let's look at the right. It's once again, I said a 9-to-1 ratio, but what is the largest component of that liability section? It's mortgages. Okay, mortgages are applied to homes and maybe, second mortgages, maybe we hope people aren't too stretched there, but overall, that ratio looks great. And then if I look at the other areas, sorry, I hope that's the last one. The student debt line is one that gets a lot of attention. It is over $1 trillion. Yes, there are some very specific situations that it could use work, but in aggregate, it's a very containable number, once again, at that macro level. Let's look at the actual debt situation on the right top side. We know that debt service ratio, the amount of disposable income that goes towards debt maintenance, is lower than it was back in 1980 when interest rates were so high. It's lower than it was at its peak in late 2007 when leverage was higher than it should have been. It has increased. It likely will continue to increase modestly as we get some rate increases from here from the Fed, and we're going to talk more about that. But there is a lot of room to move. And in particular, why do we feel that there is a lot of room to move, a lot of flexibility here? Look at that bottom right. There are some big peaks and starts there, but basically, this is the amount of disposable cash that people have on hand, and it is a lot. It has come back down a bit, but overall, we are still looking very strong. There's a lot of cash there that can be used. The question mark, of course, as it always is, how will people use it? Will they still be willing to use it? These charts would tell me they should be able to, and I hope they do.
Yeah, but a follow-up question to that is, with inflation running at 8.5%, are consumers able to keep up with inflation? Yes, their balance sheet looks great right now, but the cost of living is getting higher everywhere. And how do consumers match their income to those expenses? Well, wages are up. That's great news for consumers. That's another piece of this puzzle that supports the strength of the U.S. consumer supporting the economy, especially amongst low-wage earners. You can see year over year, wages are up about 6%. Less so for middle and high-wage workers, but still up nicely. Now, real wages are down because inflation is running hotter than these numbers, but it still mitigates some of that impact. The bottom chart here is very important when gauging the risk of a recession. And this is the unemployment rate. We like to see it come down over time, and unemployment has come down very significantly over the last couple of years. If unemployment were to rise, that could be a harbinger of a recession. In fact, we have not seen a 0.35% rise without a subsequent recession. And we've seen a few hints of recession creeping into the economic conversation this past quarter. Bryan, the biggest one has been the inverted yield curve. Why don't you tell us what that means?
Sure. So lots of talk and lots of concern maybe out there about an inverted yield curve. What does that basically mean? If I look at a normal yield curve, let's see if I can do it with my hands. A normal yield curve, I should get less interest for a shorter bond and more interest for a longer bond because of the call it exposure risk of having that bond for a longer period of time. Well, what have we seen in a few recent days, including temporarily this morning, is I might get paid a higher amount of real yield for a 2-year treasury right now, excuse me, than I do for, say, a 10-year treasury. Right now, the concern really on this is different than it's been in the past because this yield curve is so flat. I tell people you could essentially land a plane on it. The 2, 5, 10, and 30 are basis points, like percentages of percentages apart from each other. Why does this matter? Because along with things like GDP, which right now the estimate for this first quarter is to be just barely positive because of some of the supply chain issues and increased costs and maybe pushing some things off, that if you have 2 of those quarters in a row, that is one indication of a recession. One forecast of a recession is look on this chart and see those blue shaded areas. Those are the times when we've actually had recessions, going from the 1980s to the one that we all remember in 07, 08, to, I believe, the shortest one that we ever actually can see, which would be in about 2 months in 2020, which was very much sort of man-made because it was because of lockdowns. But what do we know in those areas? An inverted yield curve is one indicator that can forecast recession. There's a kind of a classic old saying that they have forecast 9 of the last 5 recessions because it doesn't always lead that way, but it does tend to lead that way. The next question would be, what does it look like now and what might happen when?
So with the inverted yield curve, raising the awareness of a recession or the conversation of a recession, I think one of the things you don't want to hear as an investor is this time is different. If past inverted yield curves have predated a recession, perhaps the current situation predates a recession. There's reasons why it may not, but let's move ahead with the argument that it will. How does that impact your equity investments? And Bryan and I are going to show you a couple of slides here that really argue as to why you should remain invested despite an inverted yield curve. This chart shows the last 4 dates of an inversion, 88, 98, 05, and 19. And you can see the peak of the bull market was well after that inversion took place. In some cases, almost 2 years after the inversion took place. Equally important, the average S&P 500 return during that period was 28%. So yes, we had an inverted yield curve, and perhaps that will lead to a recession. To clarify that, an inverted curve does not cause a recession. It's just an indicator of economic weakness down the road. So if the bond market is indicating economic weakness down the road, should you sell stocks? Well, this chart would suggest no. Also, our argument that the consumer, which is the bedrock of our economy, would indicate no. Bryan, talk a little bit about the volatility that we saw in the first quarter. Should investors sell their stocks because of the ups and downs we've seen in the stock market over the first 3 months of the year?
Sure. So one thing that does lead out of, say, this discussion about inverted yield curves and the aggression of Russia, excuse me, and some other of these factors is you get an increase in the amount of volatility. There's an indicator here, a gauge called the VIX, the volatility index, the fear gauge. And what this chart shows me is that there have been periods of time in the past. This goes back to 1997 all the way through the most recent period, where you've had multiple days, call it 10 plus days of a VIX, a volatility index reading of 30 or higher. What does 30 mean? It's kind of hard to say exactly to someone who doesn't really watch it all the time, like I tend to do, because it doesn't really go on a 0 to 50 or a 0 to 100 scale. For frame of reference, we'd like to see it in maybe the teens to the low 20s. What is the highest it's ever been? About 85. So again, it doesn't go to 100, right? The highest ever was in March of 2020, because that just seemed to some eyes to just come out of nowhere. Okay, but what really happens when you have a longer period time, 10 plus days, all the way out to, look, in 2009, almost half a year, where every day is 30 plus in a row? Does that mean you immediately need to sell? Well, no, I know that because the next 3 months, only 2 of those instances were negative. What about the next 6 months? Again, only 2 were negative, and one of those was just barely. What about the next 12 months? Only 1 of those was negative. And what about that period? That was the double dip of having the drop in tech stocks followed by the tragedy of 9/11, right? That was a double impact that we haven't tended to have in other situations. What is the general situation here? We have a period where 3 months later, you have a return of, you can see it, almost 9, over 12, over 20. Very similar to the stats we saw in the previous chart. They do tend to go together quite closely, right? There are more instances here than there were on Erich's chart, but still the idea of having volatility, all that people ask me, when is the volatility going to be over? And I'll say, it never has been yet, so I don't know when it will be. There's always something out there. These periods have had a more concentrated view of what those somethings are, And even there, you come out the other end, and we've, in every instance except one, we've had 12 months later significant return off of these periods.
All right, well, how about valuations, Brian? Are stocks expensive at these levels?
I would say that they are more expensive than average, and we're going to look at some specifics on that. But there is still a consideration for why that is okay. The big crux right now is that consideration will start to change as bond rates increase. Basically, the chart itself, the actual line chart, shows that we had about a 15-year period from 1996 to about 2010, where all the disruptions ended up causing almost no real return, right, on change in market value. That's that you can see kind of like a double pyramid shape almost. What happened after that? The longest run of upside that I've ever seen in my lifetime, and we'd probably have to go back to the 50s to see something like that. That caused some valuation increases, sure. But let's look at the box. What is the real key distinction here between past periods and now? In 2000, price to earnings ratios, the amount paid per unit of earnings for stocks was way too high, to the order of 25. You can see that on the left-hand side there. But when those got too rich and people were ready to step away, they could move some of their money, hopefully not all, into treasuries and get over a 6% yield, right? So I traded off a stock with its upside downside for a treasury with a 6% yield. In 2007, the expense of stocks, the PE ratio, wasn't really that high. Why? Because we were heavily over leveraged, right? That's what big factor that led to the housing crisis, et cetera. But once again, if I wanted to exit some of my stocks, I move over to treasuries and get over a 4.5. There's some trade-off there that I can see some relief on some recurring income. 2020 and 2022, what's the impact of having interest rates be at or near zero? That relief on the bond side that I might mentally feel for a period for having exited some of my stocks isn't there. Let's look at 2020 and now, though. Look at that price to earnings ratio. It's almost identical. Even with that increase in the index value from 3,300 to 4,500, it still didn't increase the PE ratio. Why? Because earnings have improved, even during a period of lockdown, et cetera. The infusions of cash and things have helped there. What is the number to watch out for? The bottom right-hand corner. That 2.3 at the end of the quarter is now 2.9-ish, 2.85, knocked on the door of a 3. But if that continues to increase, that would show some upside to people for maybe trimming the stocks. But overall, while we are still in this situation where rates are still low, even with all the concerns and sort of headlines, we've had one rate increase. What we see there, though, is that trade-off starts to get a little more attractive. But as of now, with bond rates being where they are and with actual lending rates being where they are, I can't say stocks are too expensive. They're modestly expensive, but they're not outlandish.
Well, one bit of good news thus far, Brian, is so far second quarter earnings announcements, which are the first quarter results, have exceeded expectations by about 80%. So companies are doing very well, having really, in many ways, reconfigured their business during the pandemic to get more efficient, to pass on cost to consumers. And that last point, I think, is really what is driving the value versus growth dynamic. Is value companies are traditionally better able to pass on those cost increases that might be inflationary to their customers. You can see on this chart, and we included this effectively because our portfolios are biased toward value. We have an overweight of value stocks in our client portfolios, and we want to share why. But this shows value outperformance by inflation regime with 3 different regimes: high, middle, and low. And we're currently in this high inflation environment. Value stocks are positioned to do well. Even should inflation come down, as those expectations showed on that chart Brian discussed earlier, we're still looking at middling inflation. I don't think a low inflation environment is in the cards right now, unless we are headed to a recession, and that's really the only thing that could push us into that low inflationary environment right now. So given that we don't feel we're headed for a recession imminently, We really like value stocks right now. We think investors should continue to focus on that part of the equity market. Those are the types of companies that pay dividend. They're typically slower growing companies, maybe biased less toward technology shares and more toward consumer staples companies, industrials companies, companies that that may have a lower valuation and perhaps less inherent risk than a growth company might. All right, so let's finish with bonds, and really putting bonds last in the presentation, it does a disservice to what's happening in the bond market, because this has been a historic quarter for bond investors. This first chart shows why. On the far right, just above the blue line, you can see a month ago on March 14th, investors thought that on December of 2020, the Fed would be between 1.75 and 2%. So that's what the blue line is showing. That's kind of the average expectation for bond market investors. Well, fast forward just over a month, and the current expectation is between 2.5 and 2.75%. So we've had a dramatic increase in bond expectations in just a month. If you went back even a month prior to March, this would look even more dramatic because expectations have grown throughout the year as those inflation numbers have come in. With 8.5% inflation, the Fed is forced to act, and forced to act in a very aggressive way. And that has caught bond market investors by surprise. Now, not all bonds have been the same, but Bryan, why don't you talk a little bit about the bond markets in general, and then we'll talk about diversification.
Sure. Yeah. So what has happened this year? I think the biggest impact here has been the Fed belatedly, which is, I'm not the only one saying that. They're saying that, stepping up and saying we need to stop this, right? So why has this been such a shock to the bond market? Well, if you look a year ago, Erich mentioned a month ago and 2 months ago. Let's look back about a year ago. The Fed came out and said, as clearly as they ever say anything, we are looking at one possible rate increase, 1/4 of a point at the end of 2022. That was the mantra that happened during 2021, or 2020, really, even into 2021, as we started to get some inflation readings that they weren't nearly what they are now, but they got into the 4s, they got into the 5s. And even at that point, we heard the word transitory and such. Okay, well, as the reality of the situation started to embed itself, what did we see? Bonds, like say a 30-year treasury that gets issued at $100 per unit, was trading literally in some cases at $140. Okay, why would anybody do that? Why would some rational person do that? Because the Fed had said, and projections said, we would not need rate increases. So that 30-year bond that was issued with a 3% coupon looks so much better than one that might have come out next that would be at a 2% coupon, that we're willing to overpay, right? There's a lot of math, a lot of very smart mathematicians go into this bond calculation, and a lot of those were based off of projections from the Fed that turned out to be wrong. Okay, so what have we seen since then? Let's look at this chart here. This is the return trajectory of the global bond market aggregate index for a wide range of years. Previous to this year, the worst outcome at this point, or by now, by the end of this year, would have been about -5.5. The best outcome was back in 1995 of 19.5. What have we seen so far this year? Unfortunately, it's that dark black line. It is about a -10. Again, we're going to show you in a minute here. That's not all bonds. That is the aggregate bond, but it's very much driven by an oversupply of too many new long bonds that were overpriced, or not overpriced, sorry, they were overpaid for, right? They're all priced the same. They come out at 100 and people decide what to pay for them. They decided to pay too much. What have we seen since then? An expectation that rates are going to rise. And what has been negatively impacted the most? The things that were overpaid for, just like with growth stocks, excuse me. So the most shocking part of this downturn is to perhaps just go back and look at what the prices were that led to this sort of a drop. That's they go together very closely.
Yeah, and I think it's important to note that this has the greatest impact on conservative investors, because conservative investors traditionally have a higher rate of bonds in their portfolio. But there are ways to mitigate the impact of a minus 10% bond market. And we've never seen anything historically like this. You can see this chart on this page looks nothing like any of the preceding years in history. So Bryan, how do you mitigate those losses in the bond market? And what should you do now? Kind of thinking back to that question at the beginning, is the dislocation behind us? Can bond investors rest easy, knowing that the Fed has changed course so dramatically and that we should be closer to expectations going forward?
I would say yes, and here is a great description of why. So oftentimes, both stocks are thought of as a basket with not much distinction underneath, right? Like stocks were up, stocks were down. Bonds were up, bonds were down. What we saw in the first quarter was both stocks and bonds at the broad level dropping dramatically. Again, I'll note, like I did just previously, let's put some more meat behind it. Why was that? Because growth stocks were broadly, like especially the biggest ones, many of them very overvalued versus any sort of historical metric. Long bonds, what is long in this case? Call it 20 plus years, 30 years, were very overpriced. Again, for the same reason that there was sort of a kind of rest easy expectation that these long bonds weren't going to burn people because rates weren't going to increase enough to make those long bonds unattractive for their holding period. What do I see here though? In the first quarter, the dark blue lines, there's a lot of the lines, just drag your eyes down to the bottom. 3 of those categories had over a double-digit drop. 2 of them in particular are long treasuries, that's the minus 10.8, pretty long IG, which is investment grade corporates, right? So it wasn't just long treasuries, it wasn't just long corporates, it was long bonds. And why? Again, because the pace and the scale of these rate increases, shouldn't have shocked everyone, but it did. Even those, the very smart bond investors said, well, the Fed said this. Well, then the Fed came out and changed course. What do we know though for some of these other numbers? Minus 2.5 for short treasuries. We have positions there. Minus 5, say perhaps for some of the mortgage backs. We have positions there. I don't love to see minus 2s and minus 4s and minus 5s, but it's a lot better than a minus 10 and a minus 11. But if you think about the phenomena here of what has really impacted those drops, it is the most expensive things that had the best returns during 2000, call it 19, 20, and 21, which was growth stocks, big growth stocks in many cases, and very long bonds. Neither of those will be positively impacted. They'll both be dragged down by rate increases, especially a series of recurring rate increases, which we really need. Okay, well, what is the response to that? Value stocks, which let's go way back to the quilt chart, was clearly the best returning class for the first quarter, lost by far the least, and shorter bonds, right? Because those both have the ability to adapt to these rate increases and in some cases take advantage of those rate increases. So again, stocks and bonds both, they didn't all go down to the same degree. So don't think everything's down, just like everything wasn't up to the same degree. There's a lot of nuance there. This shows us that there is opportunity in losing less and then being positioned to gain more going forward.
All right, and with that, that concludes our comments on the first quarter and our outlook for the economy. This presentation is going to be available on our website. So if you want to revisit anything Bryan or myself said, you can find the webinar at cutler.com. I want to thank you all for joining us today. Obviously, we covered a lot of ground here. If you want to talk to either myself or Bryan, feel free to reach out to either of us, or you could reach out to your advisor at Cutler at any time to talk about how this might impact your portfolio. But with that, thank you very much for joining us, and have a great day.
Thank you, everybody.